Hey out there, welcome into another edition of Market Takes. Man, it's a great day for financial news, a great day. I appreciate you tuning in. I know you could have been anywhere in the world, but you are here with me right here on Market Takes. I am Dion, Rabouin, reporter at the Wall Street Journal. Before we dive into our usual look ahead at what's going on this week, we've got to take a second, step back, and talk about what's going on with First Republic Bank, the sale to JPMorgan Chase. We will be breaking all that down, talking about how that could affect the markets going forward and what to watch out for next. But of course, as always, not only will we be talking about First Republic and what happened today, I'll be breaking down the three biggest things you need to watch out for this week. Now, this week, in addition to First Republic, coming up, we have the Fed's May meeting. This is a huge week. The Fed meets on May 2nd and 3rd. We will hear from Fed Chair Jerome Powell on Wednesday. We will talk through that. We also get the jobs report on Friday, but in addition to the jobs report, there are two other big reports coming out this week about the labor market that you'll want to tune into. And third, we get Apple, Berkshire Hathaway, Pepsi, Pfizer, BP, Airbus, and many, many more. This is the biggest earnings week thus far for the first quarter period. We are going to break down what you need to watch and what matters. So we will get into all of that. But first, let's take a second, step back, and talk about First Republic and what happens. Now, this is the second biggest bank failure in U.S. history. You're talking about a bank that had nearly $200 billion in deposits just about a quarter ago, a little over a quarter ago at the end of 2022. That has been seized. It was seized by the FDIC, the Federal Deposit Insurance Corporation, and sold to JPMorgan Chase. JPM assuming all of First Republic's $92 billion remaining in deposits, also buying most of the bank's assets, including $173 billion in loans, $30 billion in security. The FDIC hit, that's the taxpayer, is going to be $13 billion from its insurance fund. The FDIC has an insurance fund for just these sorts of things. JP Morgan also said it will receive $50 billion in financing from FDIC. This is the second largest failure after, if you all remember, Washington Mutual back in 2008. That was the largest. This is bigger than Silicon Valley Bank, bigger than Signature. This was the nation's 14th largest bank. This is big news. Interesting to note, JP Morgan also is the bank that took over Washington Mutual. So now JP Morgan is the buyer or the company taking over the number one and number two largest bank failures in the history of the US. So really quickly, how did we get here? Well, listen, most recently, you guys have seen what happened with Silicon Valley Bank, Signature Bank, just this rush of deposits out the door. Well, investors found out First Republic lost about $100 billion in deposits in a March run on the bank following its earnings reports that just came out last week. Now, the bank stock lost almost 50% of its value in one day. That was just investors saying we have no confidence that after this $100 billion in deposits went out the door, this bank can still hold up. The bank had taken on about $30 billion in deposits from the big five. That's US Bank, Wells Fargo, JP Morgan, which now owns the bank, Citigroup, and those guys, those big names. But they were unable to sell or put a deal together before they reported earnings. And once they reported that $100 billion loss, man, the wolves were in, the stock was sold out, and this was a huge, huge loss. You had a collection of uninsured deposits. Now, if you've seen the run on these banks, what we saw and what we have seen is just a run on the banks from the biggest, or from the banks with the most uninsured deposits. Uninsured deposits are basically deposits that are over $250,000. The FDIC says, we're not going to insure that. You take the risk if you put money in a bank that's over that amount. Silicon Valley Bank had 97% of its deposits were uninsured. Signature Bank, 90% of its deposits. First Republic, 68%. So what comes next? Well, the next largest bank, or the next bank with the largest share of deposits uninsured, East West Bank, 67%, Comerica with 64%, Western Alliance, 55%, PacWest, 52%, Zions Bank, 51%, Key Corp, 47% are KeyBank. So listen, all those are stocks to watch out for. Keep your eye. I want to put something up here on your screen really quickly to just kind of show you the overall reaction now. What you're looking at right now is the year-to-date performance of the KBW NASDAQ Bank Index. Now this is all the banks, an ETF that follows all the big banks. It's Washington Mutual, it's JP Morgan, it's Citibank, but it's also some of those regional banks. And over the course of the year, you've seen just a huge downturn. But over the last couple weeks, you've seen a little bit of a pickup. But let me throw you early to today and what we're looking at right now, you're seeing a little bit of turmoil. Now, First Republic shares have been halted. First Republic is no longer trading after the seizure and sale to JPMorgan. So it's not hurting the overall movement of this index, but we are seeing overall down. The index is just a little bit negative for the day, but it's picking back up. We're seeing maybe some bullishes, maybe people thinking, okay, the worries about the overall banking sector are overblown, and let's not overdo it. So that's just illustrating right now the mood on the banks. You're not seeing a major sell-off right now in terms of the overall banking index, but obviously those bank shares a little bit negative on the day. Listen, what comes next? Will all First Republic Bank branches become Chase Bank branches? Like I said, Chase has taken on those depositors. So if you are a First Republic Bank customer, you now bank with Chase, whether you wanted to or not. And investors not really excited about the banking sector, but we're not seeing a major sell-off like we did after SVB and Signature and some of those collapses. A lot of this priced in, and like I said, First Republic has been halted for trading. Uninsured deposits right now becoming a little bit less of the story. What's becoming a bit more of the story is what's on your balance sheet. What are you invested in? A lot of these banks hadn't invested in risky assets. It wasn't like First Republic or even Silicon Valley Bank was invested in a lot of, credit derivative swaps and things like that. Weren't invested in crypto and things like that. These were a lot of treasuries, mortgage-backed securities. What happened was they had taken huge losses because the Federal Reserve had raised rates at really the fastest pace in history when you judge by how low rates were and how high they are now. This is the fastest rate hiking cycle in history for the Fed, and that cuts into the value of those bonds. And so safe things like mortgage-backed securities and treasuries become unsafe because you lose value, and a lot of these banks weren't writing that value down. And so as they had to take on more cash to hold up and pay for and give money back to their customers, because again, all those deposits aren't owned by the bank. They're owned by their customers. They're liabilities, meaning that the bank has to give them back if customers want them. And customers were coming saying, hey, give me my money back. That meant the bank had to come up with the money for those losses they'd suffered in the market from the treasuries and mortgage-backed securities, things like that. But now we're shifting into a new phase where I think there's going to be more worry about, hey, what do you own? Are you invested in any risky stuff? Are you hedging? Are you properly covering your risk? Because that was what wasn't happening at Silicon Valley Bank. And I think the fact that First Republic did not have a plan in place before they reported an earnings loss of $100 billion in deposits, well, that suggests that maybe they weren't doing their due diligence as bankers as well. And that, I think, is going to be the question for investors. Are you doing your due diligence? Are you insuring your deposits? Are you doing and taking the steps necessary so you don't suffer a bunch of big losses? That, I think, segues us perfectly into what you need to be watching for the rest of this week, because we have a Fed meeting, ladies and gentlemen, coming up later this week. The FOMC is meeting on Tuesday and Wednesday of this week. That's tomorrow and the day after. We will hear from Fed Chair Jerome Powell on Wednesday. Fed widely expected to raise rates by 25 basis points. That's basically priced in. A hike for May is almost completely priced in from the market. What we don't know is what the Federal Reserve is going to say at that meeting. What's Fed Chair Jerome Powell going to tell us? What's he going to say at the press conference? And what's that statement that they put out at 2:00 p.m. Eastern time on Wednesday going to say about how the Fed is viewing the market, how they view this latest failure and collapse of First Republic in light of the overall banking sector in terms of banks taking on more borrowing from the Fed and all of that. So I want to put something up here on your screen next right here, and just so we can talk about what's happening in the markets. Now, as we look out at the markets, this is the U.S. Treasury yield curve, and that shows us how much bonds are yielding right now. As you see on the left side of your screen there, that's 1 month to 6 month to 1 year. Now, a treasury yield curve is supposed to look basically the opposite of this. It's generally either a straight line or something like a Nike swoosh, where if you're loaning the government money, because that's what these treasury bonds are, they're loans to the government. Well, think about loaning someone money. If I tell you, I'm going to pay you back this $100 you loaned me in a month, you'd say, okay, well, maybe give me $1, maybe give me $2 just to make up for my time. But if I say, okay, well, I'm gonna get this $100 from you, I'm gonna pay you back in 30 years, well, you're probably like, whoa, 30 years? I don't know what's gonna happen in 30 years. You got to make it worth my while. You're gonna have to pay me $5, $10, for that. That's usually what happens. So as the further you get out on the curve, the higher interest payments usually are. The opposite is happening right now because there's fear in the markets. and there's the expectation that the Federal Reserve is going to keep raising rates. And so you see 1 month, 2 month, 3, 4, 6 months, all around that 5% level, going from 2 months to about 6 months. And then 1 year you start to get lower down. That's because there's worry about recession. There's worry, oh, maybe these things won't get paid, but there's also worry that the Federal Reserve is going to start cutting rates. They're going to keep rates high in the interim, in the short term, and then start cutting. And that's a lot of what you're seeing in that yield curve. So what you're seeing right there, that chart illustrating expectations for what the Federal Reserve is going to do next. Folks expect that they'll keep rates high for a little while, maybe a month, maybe 2 months, and then start cutting them down, and that we're likely headed into a recession, which is going to force the Fed to lower rates significantly, and that's why you're seeing those lower rates longer term. So what the Fed does at its next meeting is all the way priced in. We have also seen a significant loosening of financial conditions, meaning stock prices higher. The S&P is up about 8.6% year to date. The NASDAQ of about 16% year to date, and it hit its highest since September of 2022, just last week. You're also seeing bond yields down. As you saw, that 10-year yield, which is the most traded treasury, really one of the lowest there is in terms of what you're getting paid for holding that. And we will see how that continues, because that loosens financial conditions, makes it cheaper to borrow money, makes companies more able to go out and issue stock at higher prices. Those things make it so that companies are able to participate in financial markets and get money, and the Fed wants to slow all that down. That's at least their goal. So that meeting coming up on Wednesday, you're going to want to watch that. Now, next, the jobs report is coming out this Friday, but before we get the jobs report, we will get some very interesting data on the jobs and the labor market. We will hear from, and I guess we're going to get reports on the JOLTS report, the job opening and labor turnover survey, and we will get the Challenger job cut report, both coming out this week. Now, I want to put a chart up here on your screen that shows you the latest of what we've seen in terms of the JOLTS number. And here's what the Federal Reserve has been watching. Fed Chair Jerome Powell has been pounding the table, saying that the labor market is out of whack. What you see there is there are about 2 job openings for every unemployed person. There's about 10 million job openings, a little less than that, and there's only about 6 million unemployed people. So what you have is a disconnect between folks looking for jobs and folks looking for employees. There's a lot more people looking for employees than there are people looking for jobs. That means you have to pay more, means inflation keeps pushing higher because wages can keep pushing higher. When employees know that there's a lot of job openings and not a lot of demand in terms of a lot of people looking for those jobs, well, they can say, hey, listen, you want to hire me? I'm going to take an extra 20% more than what I'm making at my current job. And I'm going to need a big bonus and things like that. And these companies, because they know they're having to compete, they're having to pay that. So this chart is illustrating the kind of out of whack state of the labor market. The Fed has pointed to that. They haven't really talked about corporate earnings, which are at record highs right now, or have been at record highs over the past few quarters. They've pointed to the labor market, and they've said, we need to see this come back into check before we're going to be able to stop raising rates or start cutting rates. Now, the other side of this coin, the other side of the labor market, is another chart I want to put up here on your screen, and that is the Challenger job cuts report, and that's showing that layoffs are starting to pick back up. We are seeing over the course of the first 3 months of this year, January, February, March, over 400% increase from March of the previous year. Now, that's still these layoff levels are still at a low level historically, but compared to where they have been, we are seeing a significant pickup ever since November of last year, or I guess since November. This chart just illustrating how that number is picked up and how layoffs have started to grow, and you're going to want to watch that report out this week. Last but not least, earnings reports. Listen, we get the biggest US company out this week reporting earnings, Apple. That is always a barometer for the health of the consumer. How much are people going out and spending on those high-priced Apple products? That definitely gives you something to keep in mind in terms of how well the economy is going. Berkshire Hathaway, they own a lot of companies like Apple. How have they been doing? How has their portfolio looked? You'll want to watch out Warren Buffett. He's always got something to say, and we'll hear from that company this week. Bud Light's parent ABInBev, they're going to be coming out with earnings this week. There's been a lot of talk about Bud Light's partnership, or its highlighting or spotlighting of its partnership or an agreement with a trans influencer. Did that really hurt the bottom line? Well, we're going to see. You know, men lie, women lie, money never lies. Numbers never lie, I should say. Money sometimes, that we'll see. But numbers never lie, and we will get the numbers on ABInBev this week. Gas company, Shell, ConocoPhillips, BP, those are all going to talk about the consumer demand for energy. There's been a lot of questions about that, and that'll give us an impact on how much are people driving. But when you're driving, you're also delivering. How much did those earnings move this week? We will find out all about all those. Airbus, that's another US company, another company, always well trafficked and highly watched because of what that says about the demand for air travel. US companies buy a lot of Airbus planes, and that's going to tell us how confident these airlines are looking forward and moving forward. Also, big tech favorites, AMD and Qualcomm also report this week. You are going to want to watch those. And that's going to do it for this week on Market Takes. I know you could have been anywhere in the world, but you're here with me, and I appreciate that. I am Dion Rabouin, reporter at the Wall Street Journal. We will catch you on Market Takes on Wednesday at the FOMC meeting, 4 p.m. Be there or be that's a square, don't do it. That's going to do it for us. We'll see you on Wednesday, 4 p.m. Eastern, right here on the next Market Takes.